Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Nuscale Power.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. We're looking at a company that is really in one of the most polarizing parts of the whole energy transition.
Absolutely.
And if you're looking at Nuscale, you have to get the core idea right from the start.
Which is what?
It's not about today. It's a massive multi-year bet on the future of small modular reactors, or SMRs.
And it's what they call a classic J-curve story.
Exactly.
Which, I mean, that sounds a bit academic, but the reality is it's extremely simple and, well, extremely risky. You're investing in a company that right now looks financially disastrous.
That's the perfect way to frame it. The J-curve means the company is, drowning in these high upfront costs.
R&D, licensing.
Billions in licensing, engineering, just scaling up manufacturing. They're digging the ditch, but the idea is that they will eventually flip dramatically to substantial long-term operational revenue.
Once the reactors are actually built.
Exactly. You're investing in that distant flip point.
Right. And if you look at the financials right now, that downstroke of the J-curve, I mean, the numbers are, they're pretty stark.
They are.
The trailing 12-month revenue is what, about $64 million?
Yeah, pretty modest.
And that's just dwarfed by the net loss, something like $380 million. That gives you a negative EPS of, what, negative $2.14? They're just burning through cash.
It's a heavy burn, for sure, but that's just the price of admission in this kind of infrastructure space.
Yeah.
It's all that R&D and commercialization spending you have to do up front.
It's unavoidable.
It is, but there's a really interesting little detail in those financials, something that points to the future potential.
The gross margin, I saw that.
Yep, the gross margin. Yeah.
It's weirdly high, right? Around 67%. How does a company losing so much money have margins that good?
Well, that margin tells you exactly where that $64 million is coming from.
Okay.
It's not coming from, pouring concrete. It's from high-value engineering, specialized tech services.
Consulting work.
Exactly. And that kind of revenue is super scalable and very efficient. It suggests that if they can get to the point of actually running reactor fleets, that operational revenue should be incredibly profitable.
Okay, so the back end of the model looks solid. But they've got to survive the next few years.
Which means they need cash.
A lot of cash. The negative free cash flow is about, what, $200 million a year?
That's right. And that brings us to their capital strategy. And really, the elephant in the room.
Dilution.
Dilution, yeah. To sustain that kind of burn rate, you need a big war chest. And to be fair, they have one.
You do. The balance sheet looks strong, about $690 million in cash, almost no debt.
Right. So that gives them a decent runway, maybe 3-4 years, depending on how fast they burn it.
But the market is definitely spooked about future funding needs, especially after they doubled their authorized shares.
From $332 million up to $662 million, yeah.
And they have that at-the-market program ready to go for $750 million. I mean, that just screams, we're going to dilute you.
It absolutely does. And the market reacted exactly that way, driving the stock down.
So why do it? Why telegraph that so clearly?
Because they have to. This capital structure is a necessary tool for funding massive projects like the TVA agreement or the one in Romania.
But why not just take on debt?
They can't, not with no recurring revenue. And raising a colossal equity round all at once would just crash the stock permanently.
So this gives them flexibility.
Exactly. They can strategically stage the funding. They match capital raises to specific project milestones, say getting a site approved, which hopefully happens at higher valuations.
Making the dilution less severe over time.
That's the idea. They're sacrificing the short-term stock price for long-term project viability.
Which is only worth it if they have a real competitive moat.
Precisely. And that's what makes the whole investment viable in the first place.
So what is it? What stops a competitor from just copying their design and doing it cheaper?
And that's the core of the whole bull case. The moat isn't just a patent. It's the institutionalized regulatory approval.
The NRC.
The NRC. Think of it like getting FDA approval for a drug. It takes billions, decades of work. Their 77 mellowweight SMR design is only the second one ever to get that U.S. validation.
Wow. So it's less of a head start and more like they're the only ones allowed to run the race right now.
Pretty much. Competitors are years, maybe a decade, behind in a line that moves at a snail's pace.
And the technology they chose wasn't some radical new idea either.
No, and that was smart. They use a light water reactor architecture, which is based on well-understood PWR technology.
So utilities are comfortable with it.
Very comfortable. It massively reduces the perceived risk compared to some experimental design. No utility wants to be the guinea pig.
So once a partner like the Tennessee Valley Authority commits resources to this specific design, the switching cost becomes huge. They're locked in.
Absolutely. And that regulatory dominance is why those anchor partnerships are so important. The TVA and NTRE 1 agreement, that's for up to 6 gigawatts of capacity.
That's not a pilot project.
No, that's the foundation.
Yeah.
And it gives them immense global option value. Take the RoPower project in Romania.
Okay.
Having one successful plant under construction de-risks the entire process for every other country or utility that's watching from the sidelines.
And you have all the policy tailwinds in the U.S. right now, which helps.
It helps a lot. The government is essentially helping de-risk the sector against cheaper fossil fuels.
Which is why the long-term view can look so strong, even when the daily stock chart looks like a complete mess.
Volatility is the keyword there.
For sure. The 52-week range is huge, from around $11 up to over $57. We just saw a sharp correction, shares down over 20% in a month.
Yeah, driven by those exact fears of dilution and Fluor planning to sell its stake.
That was the classic fear washout.
But there was a clear reversal signal right at the bottom. The RSI, the Relative Strength Index, it dipped below 30.
Deep in oversold territory.
Which suggests all the fear-based selling was just exhausted.
And that was confirmed almost immediately by the rebound, wasn't it?
Instantly. The stocks jumped, 8 to 15% in a single session on news like DOE funding and a bank upgrade?
So there was a lot of pent-up demand waiting for that low price.
Yeah, it suggests the market sees that low teens range as a key support zone. And it lines up with what analysts are saying.
Even with the dilution fears, the price targets are still incredibly high. Consensus is around $32, $33 a share.
Right, with some estimates going as high as $60. That implies huge upside, maybe 50 to 70% from where it's been trading.
So what are they seeing that justifies that?
They're betting on successful deployment, obviously, but also on an emerging thematic catalyst that could totally change the game.
This is the AI and data center angle.
This is where it gets really interesting. The narrative now is that SMRs are being looked at as maybe the only firm, carbon-free power source that can handle the insane demand from AI and machine learning data centers.
You need power 247 for generative AI. Wind and solar just can't do that.
They're intermittent. And battery storage can't scale that big, that fast, or that cheap. SMRs are perfectly positioned. They're modular, they provide firm power, and they do it without the carbon footprint.
So if a company like Amazon or Google decides to power their next data cluster with SMRs,
it completely changes the scale of Nuscale's potential. They go from being a niche energy stock to a core AI infrastructure play.
And that's what justifies those really high price targets.
It's that optionality. But let's bring it back down to earth for a second. The bear case is still very real.
And it all starts with financing and dilution.
It's the #1 risk. It's confirmed by the ATM program. Every time they use it, it's going to cause a sell-off.
And then there's just execution risk. I mean, real revenue is still years away.
Right. They have to actually build these things on time and on budget. And competition is still out there, even if it's way behind on licensing.
So if the risks are so clear, why do the analysts still see so much upside?
Because they've already factored that dilution into their models. They see the cost of funding as, the price you pay to access a potential monopoly position because of that NRC moat.
And the government backing helps de-risk it.
Tremendously. These big projects are likely to be seen as national strategic assets.
Okay, so looking ahead, what should investors be watching for, say, in the next 3 months?
The next quarterly report is key. But you have to look past the net loss.
That's a real metric.
Cash burn, yes, but more importantly, backlog growth. And the most critical thing is seeing those non-binding MOUs turn into actual binding contracts.
We need to see them move from intent to execution.
Precisely. And then project milestones, any updates on TVA licensing, any site selection news, clarity on the RoPower schedule, all of that signals progress.
And of course, the macro environment.
Always. If interest rates stabilize and the market rotates back into risk on, these kinds of long-duration growth stories could re-rate very quickly.
So to sum it all up, the high volatility in that recent washout created what looks like a potential entry point.
An asymmetric one, yeah.
You have the structural NRC advantage, major utility backing, and these huge AI and policy tailwinds. It's really a high beta way to play the growth of nuclear power.
It is a high-stakes proposition, no doubt, but the fundamentals suggest that low teens price was a very attractive zone for the long term. This isn't a short-term trade.
This is best viewed as a multi-year holding period. We're talking 3 to 7 years, maybe?
At least. You need that time to really capture the value of the licensing and the eventual reactor rollouts.
It's a bet on energy infrastructure for the next generation. It's a challenging one for sure, but
A potentially immense opportunity. A high-stakes but potentially high-reward proposition for a patient long-term investor.
don't forget to subscribe, like, and comment below to keep getting our daily stock analyses delivered straight to you.